Hello and welcome to Portfolio Matters Week 11. We have a lot to get through this week. It's been a busy week with the FOMC meeting and the Bank of England meeting. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So Keith, what have we got this week?
Well, we've got a lot, so we need to push on through this. During the week, the first checks from the Biden's $1.9 trillion stimulus bill started hitting US bank accounts. So the stimulus should be having an effect already this week. In addition, the Biden administration are now proposing a $2 trillion infrastructure bill. And you will have seen that Congress passed a bill that would allow earmarks once again. And that means the Republicans are more likely to allow the infrastructure bill to pass because they will be able to earmark funds for their little pet projects in their county. So more stimulus may well be on the way.
Just an interesting point I noticed from the announcement, Keith, is that I think one of the earmarks already there is an 80 billion bailout for around about 200 union pension funds in the United States. And we all know that pension funds are moving into a really dangerous time for them. So clearly this is a sort of an undercover way of solving a problem before it becomes a crisis. Yes. But of course, there are very, very many more pension funds in the US that are in serious difficulty that will need significant bailouts if this is the format for the future.
Yeah. We're one to watch. Okay, the Federal Reserve Open Market Committee meeting this week. So first of all, they upgraded 2021 growth forecast from 4.2% to 6.5%. So a very substantial increase in their forecast of US GDP growth. In addition, they downgraded their forecast for 2021 unemployment from 5% to 4.5%. And they upgraded expected CPI inflation from 1.8% to 2.2%. So they're expecting higher growth, higher inflation. But they took no action. No rate rise expected until 2024. Commits to maintain low rates until the US reaches full employment and the inflation target has hit 2% and is on a path to exceed it. And it will continue to buy bonds at 120 billion a month.
There's a sort of implicit assumption in that simplistic statement, Keith, isn't there, that they will move together and you will hit full employment and inflation of around about 2% at the same time.
Well,
which is a leap of faith. Yes,
absolutely. Frankly, I think this is all going to get out of control.
The other thing to notice here briefly is that GDP growth upgrade to 6.5%, but the stimulus is roughly 20% of GDP, which means that there's a sort of real GDP of the remaining economy dropping by 12%-ish, and then a 6 or 7% increment from net increment from the stimulus.
Well, they must be assuming quite a lot of it's going to be saved or go into the stock market, which doesn't produce real wealth.
Yeah, true.
And it produces paper wealth. Okay, so what about the Bank of England? Well, they've upgraded UK growth forecast without actually stating a number and stated there's no danger to return with sustained inflation above target. So it left interest rates unchanged at 0.1% and said it did not intend to tighten monetary policy till there is clear evidence that significant progress is being made in eliminating spare capacity and achieving the 2% inflation target. Well, we don't think the 2% inflation target is going to be any trouble at all.
No.
Okay, so moving on, what caught our eyes this week? Well, the first thing was I listened to an excellent podcast by Louis Vincent Gav on the Market Huddle, which I recommend to all our listeners. It's mainly focuses on macroeconomics and also on trading, which, you know, for many private investors such as myself will really not be of much interest, but it does have some great guests. Now, Louis Vincent Gav's point was that total US stimulus to date, including the 1.9 trillion Biden stimulus bill, which has just passed, has totaled $4.8 trillion. And if you divide that by the US population, that has led to an increase in federal debt per person of over $14,000 and per taxpayer of over $33,000. Now, what
that equates, sorry to interrupt you, that equates to around about $200,000 per taxpayer for the entire federal debt of 30 trillion.
Wow. So what have they got for that money? Have they got any increase in productive capacity? Have they got any increase in infrastructure? Have they, from that money, have they increased the US economy's ability to pay back that debt? The answer is no. And any of you who have been following us since the very first episode, when we discussed the book on the Scottish Enlightenment banker John Law, will know that we concluded that a country can enforce the usage of its own currency within its own country and mandate the interest rates on that currency. But what it can't control is its external value of the currency. So what I would expect from all this money printing is a decline in the US dollar.
Yeah.
Moving on. So this chart shows the allocation by US households to the equity market, and it is an all-time high.
Wow.
And more is coming. So this is really interesting. This is from the FT, and this is a survey of users of online brokerage firms, asking them what they intended to do with their stimulus check. And the answer was most that they were going to put at least 30% into the market. So more money is coming. And that's the time when inflows into equities are already high. Moving on to the US economy. This is a table that shows US PMIs, and you can see now it's at 60.8, which is higher than it ever was pre-COVID. And China is now at 50.6, which is higher than it was pre-COVID. So the manufacturing index is better than it was pre-COVID. But having said that, recent US economic data has been disappointing.
So I've just checked up what PMI means, actually, Keith. It says it consists of a diffusion index that summarizes whether market conditions, as viewed by purchasing managers, are expanding, staying the same, or contracting.
Right. Above 50 is expanding.
Yes.
Thank you, Richard. But you can see from this, the Philadelphia Fed's Business Outlook Index survey is showing very strong improvement in the economy. And as a result, inflation expectations are continuing to rise at an accelerating rate.
This is a chart that I found in the Financial Times, and what it actually shows is how difficult economists are finding it to project the rate of inflation forwards. And the confidence intervals are enormous. So each band represents a 30% probability. So you can see that they're saying that there's a 10% probability of hitting either 5.5% or minus 1.5%. and there's a 40% probability of hitting either 4% or naught. So the target that they're setting themselves, this fine target of 2%, sort of this demonstrates that it's really a sort of spurious target that doesn't really mean very much. I think we have to understand that there's a degree of certainty in inflation targeting coming from central bankers that actually doesn't exist.
Yeah, I personally think the chance of getting minus 1.5% for inflation is 0. But anyway.
Yeah, I agree.
So last week, Richard had a chart which showed, the bar lines, or this channel in the US 10-year yield. And my point with this chart is you can draw these lines any which way you like. And
you've got the lower line is too high.
Yes, exactly. That's exactly right. So anyway, it's now heading back into this channel because you can draw the channel lines any which way you want. Anyway, so moving on. You know that monetary theory, price times quantity equals money times velocity. Now, money, i.e. how much money is in circulation, has absolutely shot up. So in order not to get inflation, you need the velocity of money to collapse, and the velocity of money is collapsing. However, the velocity of money appears to be very highly correlated with population growth. And because as young people grow up, they go into the main spending period of their lives in their late 20s, when they need to buy a house and buy everything that goes into a house and borrow a lot of money to buy the house and buy all the furniture and the furnishings. So you get a lot of borrowing, and as the population grows, the whole borrowing of the economy rises. So what this is saying is that the velocity of money is about to pick up, and massive increases in M plus an increase in V are going to lead to a big increase in P.
Yeah.
Inflation. Okay, moving on. Equity markets, well, the all share was pretty much flat. S&P was down slightly. Both the US markets struggled as US interest rates rose during the week. Japan had a good week. Bitcoin had a good week. Moving on to the industrial commodities. Everything is pretty much staying near its highs.
Yeah.
The only things of interest are nickel continued to decline. It fell very heavily last week, as we discussed then. And oil had a bad week. Oil is an artificial market at the moment, in that OPEC have a load of spare capacity, and I think the oil price has rather got ahead of itself. Richard, do you want to take over?
Thank you, Keith. Yeah, so this graph shows the market value of global auto industry, and the top line, the green line, is total plus electric vehicles, and the orange line at the bottom is electric vehicle specialists. And clearly, the global auto electric vehicle market value has shot up from probably tenfold over the course of the last year or so, and this is a reflection of enthusiasm for electric vehicles. But the point I think to be made here is that ultimately electric vehicles will replace, we believe, internal combustion engine vehicles. And why should electric vehicle manufacturing be any more profitable than manufacturing internal combustion vehicles? And unless the numbers of units sold increases, why should the market value of the auto industry go up? So I think the point here is that there is this speculative bubble in electric vehicles, which is pushed by this sort of spurious, I think, first mover advantage, that the first mover is going to take over the market. And at some point, and we've recently seen it with VW, I think, in the last week, announcing its major move into electric vehicles, and the price of VW has gone up massively. Was it 30 or 40%, I think, Keith?
Yeah.
And but it's still going to be making vehicles at the same profit margins that it made them beforehand. So it makes no sense in a sort of broad way.
Yeah.
And I think if you move on to the next.
Well, before we do that, Richard, I think the other point I'd make is that essentially the market is pricing in growth for the entire industry, but everyone is only going to have one car, so in aggregate it don't work.
So the lithium price didn't change last week, but as we know, lithium is in significant demand, increasing demand as a battery metal, and we would not be surprised to see the price of lithium continue to go up. And the next graph, I think, Keith, shows there is a large emerging supply-demand gap in lithium. So presently there doesn't really exist, but we're moving into the beginnings of this gap, which is obviously caused about by a massive increase in lithium battery manufacturing and not matched by a similar increase in lithium mining. And the gap only continues to get larger. Now, this implies that you can't build a lithium battery without lithium. So there will be high pressure to make lithium batteries more lithium efficient, and presumably for other battery technologies that don't use lithium as lithium becomes more expensive.
Yeah. I'd also say, Richard, that I'm always suspicious of graphs in which there's a supply gap quite a long way in the future, because as the price rises, you are going to incentivize supply to come on stream. And lithium is not rare. You can mine it, you can produce it it's there.
China's credit cycle rolling over. So China put a huge credit stimulus, and much of that comes out in commodity prices, we believe. So the credit impulse from China, the purchasing of copper, oil, and other industrial metals, which they have probably been stockpiling. When their credit impulse ceases, then that increase in stockpiling stops. And if the impulse goes into reverse, then presumably you would ultimately get some liberation even from stockpiles. The effect anyway would be that it may be bad for the rapid rise in commodity prices that we've recently had. Having said that, of course, there is other demand coming on for particular commodities throughout the world.
And also, the other thing I would say, Richard, is this chart is annual change. So when the Chinese credit impulse turns, it's not that commodities fall, it's just they don't grow as quickly. So the annual rate of change declines. I think we covered this. So this is crude oil. You see, it had a bad week, but the trend is clearly up, and OPEC is in control of this market. And frankly, I think it just got a bit ahead of itself. Okay, moving on to precious metals. Good week. Gold has recovered some of its poise, up 2%, silver up 2%, platinum up 2%. Rhodium, which had a bad week last week, has bounced back. And what's the only thing of real interest is palladium, where the high price of rhodium is causing some spillover into the palladium market. Richard?
I thought this graph was quite interesting, Keith, because it's an index of the gold mining shares, and it compares it with an index of gold sentiment at the bottom. And what it sort of purports to show is that we have approached a region of extreme pessimism, and therefore that's very bullish for the gold mining shares. And you quite often see this type of a graph in articles that are promoting gold as a good investment. Now, I actually think gold is a good investment, but when I see this sort of graph, I just feel a bit jaded by them, because it doesn't really show anything, I don't think. If you look at the previous major lower on the sentiment in the middle of 2013, well, from that point onwards, the gold price continued to drop down to about $1,130 and took the mining shares with it. So I just think this is rather a spurious correlation, and it's very easy to get suckered into thinking you have to buy gold mining shares now when you look at this graph. But again, if you look at 2001, Nothing really very much happened in the sentiment index, other than it's really quite volatile. And the price of gold chugged up for the next 9 years.
Yes, absolutely.
So I don't think the sentiment index shows very much at all, frankly.
Okay, rhodium. You can see rhodium bounced back, heading back towards its highs. If you've got some Sylvania platinum, you're going to be very pleased with this chart. And palladium, shooting up, sir.
Yeah. And of course, Sylvania produced quite a lot of palladium, I think, as well, don't they, Keith?
Absolutely. And those of you who have followed this podcast will have hopefully watched our share talk on Sylvania Platinum and know that subsequent to that, I changed my mind and decided that even at the elevated price of the shares, I would buy some. And actually, that's proved to be a good move as rhodium has headed up. Okay, so what about rates? Well, rates, unsurprisingly, are continuing up. So you'll see, actually, it's not a getting out of control, but it's just steadily rising each week. Richard?
So Ray Dalio issues a free newsletter, and it's fascinating to read it, but he has some great charts in it. And you can find it very easily just by Googling it. But this one shows USA debt and credit liabilities as a percentage of GDP. And this is total liabilities. I believe it includes things like social security debt liabilities, and it's just enormous. And it leaves you wondering where the financialization of the economy is going to, and how it's all going to come back to some sort of normality. And I don't know if it's particularly indicative of anything other than the system is possibly not very healthy. What do you think, Keith?
This is a chart which can't carry on forever, is the bottom line. Now, if you look at Japan, obviously total liabilities keep on growing. So this is not a problem in the short term. It's just one of those things where the amount of debt increases the fragility of the system. And one of the things I'm very much expecting is more volatility in markets.
But also, of course, as we discussed earlier, the ability of the economy to repay the debt becomes impaired, and ultimately the economy can't service the debt, can't even service the capital. So this is nominal payback, again from Ray Dalio, nominal payback period on the left-hand side in years of cash and bonds, which is at sort of 50 years. And the real payback period, i.e. interest rates less inflation, is 500 years, which is quite extraordinary. It basically means if you buy a bond now at these rates of interest, you will never get your money back. If you like, there's a conversation at two levels, isn't there? There's a conversation about what's going to happen to the stock market and what's going to happen over the next few months, and there's all this money going in. But fundamentally, you look at this, you think, well, where are these economies going ultimately? As Keith said, because you can't persist forever. And when it changes, it's going to be very unpredictable indeed.
Yeah.
But it may not change for a long time.
Yes. Well, I'm actually amazed the payoff period is positive. I mean, in Europe, it wouldn't be. It'd be infinite because you have negative real yields. No, negative nominal yields, sorry.
Yes.
In some cases.
So again, these charts just show the extreme positions that we are with cash and bond yields, nominal and real rates. And this is in the US, UA, Europe and Japan. And as Keith says, in Europe, we've got significantly negative real bond yields. But it's more of the same. How do we move back into a more normal environment without causing horrendous damage?
Well, the other thing I would raise from these charts, Richard, is that we have been talking in recent weeks about the rise in US rates. And the rise in US rates that has happened since the start of the year is a blip. It doesn't even register on these charts, and it is already causing a sell-off in the NASDAQ. When it gets going, hold on to your hat. Again,
so the USA budget deficit, which is from 1950 onwards, has been on a downward trend, moving from a surplus in 1950 or so, and it is on a, you can draw a trend line through that, Keith, if you wish to.
Yeah.
The current account deficit heading in the same direction, the monetary base going up, And then we have the projection of fiscal support. So, and what does Ray Dalio say? So I extracted this from his newsletter, and I summarized it very slightly. But basically, he said, because I believe that we're in the late stage of this big debt cycle that mechanistically works in the way I've described, I believe cash is and will continue to be trash, i.e. have returns that are significantly negative relative to inflation. So it pays to borrow cash rather than hold it as an asset and buy higher returning non-debt investment assets. In other words, be invested in stocks and real physical assets.
Absolutely, and we would absolutely concur with that advice.
Yeah.
Okay, so just finally, this is the S&P Futures seasonal chart, which we do every week, and frankly, the S&P seems to be following this very closely. So we are mid-March, and it's had a little blip. Next week, expect positive return. Right, Richard, your personal charts.
Thank you, Keith. So my portfolio review for the weekly change up 6.5%.
Wow.
But my year to date is only 4.7%. And my silver mining shares had a decent week, and I purchased after Keith had identified it when he did his Bushveld share talk, which created some discussion, I have to say. But Keith will be presenting a more in-depth analysis of this company shortly. But I purchased some of these on Friday and on Monday, and they have done extraordinarily well. The timing was totally fortuitous. I also purchased another one of Keith's recommendations, Petro Matad, and I purchased Open Orphan, which Luke, on his podcast last week, recommended as an interesting pharmaceutical play. I actually needed to raise a little bit of money to fund some of those, so I've been a long-term holder of Kirkland Lake Gold, which has done well for me, and I sold a portion of that. Over the recent months, it's really gone nowhere. So a little bit of a downward trend, slightly disappointing. And I use some of those funds to make my purchases. I would actually like to buy back into Kirkland Gold and take my holding back up to what it was, but I thought there are some intervening opportunities that I didn't want to give up.
Right. Well, you are following our guidance, Richard, buying the stuff that we've been recommending. Great. Yes,
Keith. But I think one has to be very careful and not become hubristic about this. And I think, as I said, the timing of ferro alloy resources was total fortuitous.
Yeah.
So Bitcoin, as Keith said, was up a little bit during the week, but it is still wandering around trying to work out where it's going to go next. As is Ethereum. I still hold my much reduced holdings of those, 1/3 of my original size.
What was responsible for your 6.5% return last week?
It would have been the gold and silver miners.
Yeah.
And ferro alloy resources, which basically doubled.
So how much did you buy?
Friday and Monday afternoon, and I think I just had a few things go in the right direction, Keith. Bitcoin went up a bit.
Right. Okay.
Yeah.
Well done. Okay. Well, let me share mine. Okay. Well, sad to say, I had a bad week.
Oh, Keith.
Yeah. Well, I'm sick, green with envy now that you've had such a good week, Richard. Because I have a lot of oil stocks, and oil price came off, and so they came off. So that leaves me up 4.5% on the year. We're very similar on the year. We just fly around each week. And actually very similar to the oil share. So, as a result of all this effort, I've matched the oil share. Great.
Just buy an ETF, a lot easier.
Yeah. So I did some partial sales this week because I needed to fund some purchases. So I partially sold part of my stake in Bushveld and part of my stake in Hochschild, both of which I've made good money on, because I wanted to buy some ferro alloy resources. Now, just like Richard, I was very lucky last week. We were analysing Bushveld and came across Ferro, and I thought this story just looks too good to be true, and I will buy a little bit of it before I analyse it this week. So last week I bought a tiny amount, and then on Monday, essentially all hell broke loose, and the shares trebled in the course of 2 days. Now, when Richard phoned me Monday morning and said, have you seen this? I bought a bit more. So, it's been incredibly fortuitous. And today I've actually bought even more. So.
Well, it's interesting you should say that, Keith, because I also topped up this morning on it.
Yeah.
And I think when Keith does his share talk on it, people will understand why we're enthusiastic about it.
Yes, absolutely. So just quickly going through some stocks we have covered in Share Talk, which had some news. Now, we were cautious about Petrofac because of its legal problems and the fact that there was it had loads of risks. And one of those risks came to fruition this week when the Abu Dhabi National Oil Company, ADNOC, banned them from bidding. I mean, Petrofac have to come to terms with the SFO and do a deal over Unaoil. Otherwise, their business is going to die.
And they need to rebuild their reputation, don't they, Keith?
Yeah, absolutely. So you can see its shares hit new lows. It's a declining chart. The CEO is watching, do a deal. Now, the other thing was Capital, which we liked and was one of our very earliest share talks, and whose shares been drifting off. And we were saying was a growth company with very cheap share price. And it had its results. Results were great. Revenue up 17.5%, EBITDA up 24%, admittedly partially because of its investments, which have done well. But still, this is a growing company which is on a low P ratio. And I noticed this morning that Paul Scott of Stockopedia was recommending it, and the shares were up 9%. So you saw it here first in January on this Portfolio Matters. And that's the share price. So that's it for this week. A lot to get through. Thank you all for watching. Richard is on his boat. You'll realised why we don't record, on Mondays and Tuesdays. It's because Richard's on his boat. Anyway, so thank you for all watching. I hope you'll press subscribe and like. And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.